In the 1600s, tulips cost more than houses. When the bubble popped, fortunes vanished. It's the same psychology behind modern crashes. Hey, it's me! Here's a riddle for you. What did the tulip say when the market crashed? Nothing. That's right. It went totally bulb. History doesn't repeat, but it rhymes. So today I want to take you back to the first market bubble ever recorded, the Dutch Tulip Mania. That way we can learn how to spot bubbles early so we can protect our wealth during the next one. Because here's the thing, cycles like this aren't going away. And if you understand them, you can use them to your advantage, or at least that's what I try to teach my son. So let's start with the basics. Why do bubbles happen? Well, the answer is simple. People buy assets not because they're valuable, but because they think someone else will buy them later. They're betting on other people buying the asset, not on the asset being useful. It sounds dumb, but it's human nature. And nowhere was this more apparent than the Netherlands in the 1600s. Back then, tulips were the height of fashion. It was a status symbol, like owning an NFT today. So naturally, everyone wanted them. Farmers started planting more and more, and soon there was a surplus. A regular tulip was worth about 3 guilders, but some rare ones were worth up to 12. And that's when things started to get crazy. You see, at first, people were willing to pay 3 or even 12 guilders for a tulip, because they wanted to show off. But then something interesting happened. People started paying 120 guilders for the same tulip, then 1,200. At its peak, a single Semper Augustus tulip sold for 10,000 guilders, equivalent to $400,000 today. People didn't care if they ever saw the flower bloom. They just wanted to make money. For example, there was a woman named Elizabeth that bought a tulip for 500 guilders in January 1636. By February, tulips had risen 1,000% in 2 years, outpacing the S&P 500's best year by 20 times. And that's when things started to crumble. See, people were buying tulips on credit, borrowing against their future earnings. By now, no one cared about the tulips. They only cared about flipping them. And when people start buying, the price collapsed. Overnight, 10,000 gilded tulips were selling for 300. People lost everything. They had to sell their houses, farms, even children. One trader described it as a storm which overthrew all ranks and conditions of people. And if you ask me, it's the perfect lesson on how to spot the next crash. Lesson number 1, the hype cycle. Every bubble starts with hype. People need to want the asset. In the case of tulips, it was because they were rare. Then there's meme stocks, NFTs, crypto. In fact, every bubble has a different catalyst. Sometimes it's technology, like the dot-com bubble. Other times it's credit, like housing in 2008. But either way, hype gets people excited about an asset before they've even heard of it. It gets them emotionally involved. And that leads us to the next sign, which is lesson number 2, the greater fool theory. Now, here's the thing. Most people aren't trying to beat the market. They're just trying not to lose money. So when they buy an asset, they're looking for someone else to blame when they lose. They're looking for a greater fool. For example, in the tulip bubble, farmers planted more and more because they thought demand would keep rising. Investors borrowed money because they thought they could pay it back later with the profits. And speculators flipped tulips because they thought they could find a sucker to sell to next. Everyone was playing on the idea that someone else would pay more. But when no one else was left to sell to, the last fools lost everything. Here's the thing. Markets go up and down. If you invest in the market over a long period of time, you'll probably make money. But bubbles are different. Their prices go up extremely fast and then they crash. And that leads us to the third lesson, the warning signs of a bubble. Well, there's 3 things to look out for. First, prices rise faster than value. If you can't explain why an asset is worth what it is, that's a red flag. Second, everyone brags about profits. If your friends are making 5 figures a month, it might be time to sell. Finally, assets bought on credit. When people borrow money to buy an asset, it's usually a sign of trouble. And speaking of trouble, have you seen my credit card bill? I hate it. It's always there. It never leaves. Now, the 4th sign is media hype. Everywhere you turn, you hear about record-breaking prices, impossible returns, and overnight successes. And the 5th sign is when commentators on YouTube and Twitter all agree on the same trade. I mean, come on. Even I knew the housing bubble was about to pop in 2006. I was watching TV one day and I heard Mark Cuban talk about how real estate prices could never fall. I remember thinking to myself, well, if Mark Cuban thinks it's a good time to buy a house, maybe it isn't. Okay, so those are the warning signs. but you still don't know when it'll crash. And that leads us to lesson number 4. Crashes happen fast. Unlike the slow decline of a normal bear market, the sudden collapse of a bubble happens in a matter of weeks or days. For example, the Dutch tulip bubble popped in 1637 when speculators tried to squeeze out another 10% gain. But instead, trading stopped. Prices plunged 90%. Within a year, the whole market evaporated. Same thing with dot-com stocks. In the year 2000, investors lost $3.5 trillion in one day. Housing in 2008, $3.2 trillion in 4 months. And I'm not saying that to scare you, but to prepare you. The truth is, crashes are inevitable. Even billionaires don't avoid them. Warren Buffett lost billions during the dot-com bubble. Jeff Bezos lost billions during the crypto crash. And while it hurts to see your investments fall, especially after working hard to earn the money in the first place, losing money in a crash is nothing compared to the wealth these guys built by staying calm. Which brings us to lesson number 5, protecting yourself. Now, here's the thing. Billionaires don't avoid crashes. They prepare for them. And honestly, I wish someone had told me this sooner. When I first learned to invest, I used to chase returns and buy whatever was hot. And then when it crashed, I panicked and sold. But that strategy led to terrible results. That's why I made it my mission to learn from the best. I studied Warren Buffett's moves and realized he's been investing in boring blue chips for decades. Sure, he holds Apple now, but he also owns See's Candies. He knows that no matter what happens in the market, his investments will survive the crash and keep sending him dividends for decades to come. So that's what I did. I started buying Apple, Google, Microsoft, and Amazon. I kept buying, and I never panicked. And since then, my net worth went from $6 million to $1 billion. I realize now that it wasn't skill that made me rich, it was patience. So here's what you can do to protect yourself. First, diversify. Don't put all your money into one stock. Instead, spread it across several industries. Second, keep cash reserves. The worst thing you can do is be forced to sell when you don't want to. So keep enough cash on the sidelines to ride out the next crash. Third, focus on long-term value. Don't panic over short-term losses. Look at your investments on a monthly or yearly basis, not daily. Finally, survive the panic. Don't sell your investments just because your neighbor calls you and tells you to. He probably doesn't know what he's talking about. In fact, 90% of active investors underperform the market. So trust the data, stay calm, and stick to your plan. Then when everyone's freaking out, you can buy cheap and set yourself up for the next decade. Look, the pattern never changes. Hype, greed, credit, and panic. Learn to spot it early and you won't be the fool left holding the bag. Alright, now this story has a bonus tip, which is every crash plants seeds for the next fortune. When people panic and sell, that's your cue to buy. When others fear, you can make a fortune. Thank you so much for watching. My name is Reese from Powerful Individual. We upload a new video every week. Make sure you subscribe. Also, feel free to follow me on social media. And if you want to continue learning, check out this video here. Thank you for watching. Thanks for watching.